Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about everything financial literacy. And today, I want to talk about the 10 mistakes that you should never make. Now, this video actually came about from a one-on-one coaching that I was doing, and there were actually a few mistakes that were made when doing credit card stacking. So if you're not familiar with that, I'll link a video to credit card stacking. I talk about that with business credit cards. And even when you get approved, there are some things that you want to avoid. American Express is one of the, in my opinion, one of the easier places to get approvals, to get high limit credits. But there are some things that once you are approved for these cards, whether on the business side or personal side, there are some things that you want to avoid and that you want to make sure that you're aware of. And I just felt like I didn't do that part when I was doing that video. But now I want to specifically talk about American Express and these things so that way we can avoid any mistakes. All right, so let's get started with the first one that we're going to be looking at, and that's going to be credit card churning. Now, you probably won't see this on the business side or credit card stacking, or maybe you will. But credit card churning is the process of opening up credit cards for the sole purpose of earning welcome bonuses or other benefits. And usually it involves closing cards right after the bonus post to your account before the next annual fee is charged. And this can be lucrative if done correctly, but you should be aware that a pattern of opening and closing cards quickly is often a red flag, not just for American Express, but most credit card issuers. And the usage of this term has evolved over time, but the following scenarios are considered churning currently. So if you were to get an American Express where, let's say, the Platinum, and they had a $100 points that you could get, if you were to just do some spending to get those points, redeem those points, reap the rewards, and then close the card, that would be a red flag for American Express. They watch this very, very heavily. You want to be very careful. So if you have an American Express card and you cancel that card within 1 year, they will take back any bonus points that you were given. You could also get flagged in the future, and you may not be able to get other American Express products. So remember, your credit score is only part of your financial profile. There are other things, like everyone has an internal scoring system, and they do rank you on that. And credit card churning won't necessarily impact your credit score, but it can influence the way that you're perceived as a customer. And you definitely want to make sure that you're maintaining a good relationship and you're not triggering any red flags, any algorithms, anything like that, because that will result in your card potentially being closed, canceled, and again, in the future, you may not be able to get any other products. So you do not want to do that at all. I don't believe that credit card churning is even worth it. There are so many other creative ways that you can use your card to create income that these bonuses that you get will seem minuscule in comparison to what you can do with them. Okay. All right. Number 2, and this one is going to be, it may seem a little weird, but let me explain. You do not want to put excessive high spend on your credit cards with American Express in the first few months. Now, when I'm saying this, there are some cards I want you to take note of, like the Amex Blue Everyday card, the business one. That may have 0% APR, which it has to make sense, okay? Just know that these things have to make sense in the eyes of the bank. So if you do a 0% APR card, a lot of times those cards are meant to buy large purchases and pay them off slowly. That's fine. If it's one large purchase, or maybe it was like 2. But if you're excessively doing high spend in the first few months, that looks very, very fishy, especially when it's not a 0% APR card or like a balance transfer card. It depends on what you're doing. So my recommendation is take your time, slowly add transactions to get the card warmed up. If you make an excessively large purchase in the first 90 days, It's possible they can ask for documentation to verify the information. This does not always happen, but it's something that you should be aware of. So here's what I recommend that you do. Start off with $1,000, make some purchases, pay it. Not maybe large purchases, but just purchases here and there. Pay it like normal. Then spend $2,000, pay it. Then spend $3,000, pay it. So on and so forth. You want to slowly make a gradual increase over time, and you're less likely to trigger any red flags if you do it this way. And this is just the best way to make sure that you don't get hit with any manual reviews or anything of that nature within the first 90 days. And I would say even be cautious for the first 180 days, the first 6 months, because even then, it just depends on how you're spending. There are abnormal spend patterns, and usually getting your credit card and making a huge purchase in, first 90 days first, and then nothing else looks very, very weird. It's suspicious. It's very odd activity. It will trigger an alert, which may trigger that review, which could then get your account even, worst case, closed. So be very, very careful about how you do that. And again, there are other cards that have balance transfers that have 0% APR where something like that may make sense, but it has to make sense. All right. Number 3, you do not want to buy high risk items in large amounts. I'm going to explain that. And I have a story. I personally spent money on jewelry. I went to Zales and I got something. Okay. When I did that, it did have a trigger that asks for documentation. So you want to be very, very careful about when you do things like this. Jewelry, car down payments, things like that, etc. You might receive an email stating your account is under further review. I had to call, send documentation, how much money that I was making. So I would take that very, very slow. Okay. There are certain transactions that just you just got to see it from the perspective of the bank. If I just gave you a charge card with the spending power of $50,000, and as soon as you get the card, the first thing you do is go buy a car for $20,000. That is going to trigger a flag. That is very, very weird. If you buy something like jewelry, and the jewelry is it's a Rolex. You're buying this jewelry. What does that look like? It's looking like you're buying things that you could potentially liquidate in order to get money. It looks weird. It will trigger flags. Think about this the same way that you would think about it. That's the only way that I could really put it, because I'm not going to be able to tell you every single case and scenario and why it would be weird. But, if we're speaking objectively and we're just saying, this looks weird, think about it like that, it probably looks odd. If it does, maybe you should hold off on making that type of transaction. Just might be a better option, or get some time built up, use the card normally for a little while, and like before, gradually increase it. And then something like that may not trigger a flag because you've built up a little bit of trust with this bank. Now that you've been using this card responsibly, making payments, but in the first, 6 months, I would be careful. I would just take my time with the way that I'm spending it, or not making any excessive, crazy purchases. All right. Next thing on the list, I would avoid manufactured spending. Now, some people may have heard this term, you may not have heard this term, but manufactured spending is the process of purchasing cash equivalents with a reward earning credit card where the reward earned is greater than the fees that you incurred. All right. And it could be used to meet minimum spend requirements or racking up frequent flyer mileage, things like that. I'm going to give you another example. Let's say you were going to get a bonus of $1,500 from American Express if you spent $10,000 in the first 90 days. Let's say you went to Walmart and you bought gift cards. You bought $2,000 worth of gift cards because during Christmas time you were going to spend that money anyway. You know, you spent $2,000 on a gift card to make it look like you were going to spend this, to then just go back and then probably spend it on something else that you were going to purchase, or even buying a Visa card to then liquidate that and then pay back the credit card. That type of stuff is manufactured spending, and it's easy for them to tell. There's a reason why you can only buy so many gift cards, by law. There's a reason why. So you want to make sure that you're not making it even look like this. And in other cases, customers might meet the minimum spend requirements by making large payments on rent, car loans, and student loans. There's also a reason why certain transactions you can't make with credit cards. There's a reason why they only let you make it with cash. Even with, down payments on houses, for the most part, all just made with cash. It can't be with credit. So just keep that in mind, that, what manufactured spending might actually look like. And this can cause a manual review, which can cause your credit limits to be decreased. They can also bucket you. In worst case, they blacklist you. So you don't want to get in a situation where you get a manual review where you have maybe a $25,000 limit. They review and they drop it down to $4,000. All because you wanted to, manufacture the spending for $1,500 in rewards. Just use the card normally for a little while. And everything should really be normal, especially if you have a business credit card and you're using it for business purchases. You just want to be really careful about not spending it in a very odd way. Business transactions and spending it on certain things won't look as weird as gift cards and stuff like that. That looks very, very suspicious. That is really, really weird. And trust me when I say they can tell. They have algorithms, and I can just imagine with AI coming out the way that it is, this is only going to get, not worse, but they'll have a lot more scrutiny when you make these type of transactions. So just be very careful with that. All right, this is another one where it's pretty big. You do not want to invoice yourself. And the best example I could give of this is, let's say that I have a store, right? I have a Shopify store, and my Shopify store is Success with Stephen Smith. Let's say that I was trying to invoice myself, like I do one-on-one coachings. Let's say that I was trying to invoice myself $10,000. So that way I could liquidate $10,000. The only thing that would be charged is, of course, the interchange fee, and then whatever other fee that my processing merchant might take. So it may cost me like 5% of whatever it is, but then I can get the rest. Now I technically liquidated my credit card in order to do this. You have to have a seasoned merchant account. And what I mean by seasoned is that it's been verified, it's been used heavily, and you make these type of transactions normally. If you try to make a $10,000 transaction for a brand new merchant account that no one recognizes, that, looks odd to your bank, this is one of the worst things that you can do, because your account can definitely get blacklisted and more than likely it'll get closed. And I was talking with someone actually about this and why this is a bad idea, because for the most part, there really is not too many things you need in cash. I'm going to be honest. I can't, if I'm really like thinking about it and I'm really being honest with you, there's nothing that you really need where you need cash for the most part. Everything can be purchased with credit. So there should be no reason that you're trying to do something like this. There should be no reason why you're trying to liquidate, because in most situations, if you're trying to make money with a business, you don't need cash. It's just, I really can't think of too many situations where that would work. And again, if you have a brand new merchant account, this is not going to work. It looks crazy. You will get flagged. They will either hold those funds. Your merchant account might hold the funds. That's happened with people when they try to do the same thing with PayPal, when they try to do it with a Square, when they try to do it with Shopify. They will hold those funds and will not let you get them because it looks suspicious. They'll do it. They'll contact the actual credit card issuer. They'll verify this information. It could get your entire store shut down, especially if you have a good store and you were making a lot of money from it. There's too many things that could go wrong with this to justify taking the risk and compromising your entire account for not a lot of money. It just doesn't make sense. So I'm just going to say avoid this at all costs. I can't think of any scenario where it makes sense or it's worth it. Just avoid it. All right, next on our list is going to be do not pay late. I think that's an obvious one, but it still has to be stated. Really what I wanted to say is just put your payments on automatic payment. I know a lot of people are like, I want to go over my statement, and just put it on automatic payment. If there's if there's a discrepancy, you can figure it out and you can get the money refunded to you. But just put it on automatic payment, especially if it's your personal credit card, because it takes just one bad move, I forgot this, and you can drop your score 100 points. It's just not worth it. They always do automatic reviews. And how I know this, if I get one hard inquiry or if my score drops, I get notifications from American Express right away. And they let me know, hey, your score just fell by this many points or this just happened. They are on top of it, and they will go in, review, and they will cut your limit. You could have a limit of 25,000 and get it cut to 5,000 just because your credit score dropped. That late payment can do that much damage. And yes, we can dispute it to try to get it removed, but it's a hassle. And just to avoid the whole thing, just put it on automatic payment. It's just late payments it's on-time payments is 35% of your credit score. It is the most important factor on your credit score. You do not want to have one, and you don't want to have one on your business account too, because then they can report that to your personal. It's not worth it. You don't want to have one. You do not want to have one. Set it on automatic payment. Let it pay. Just let it pay. Worst case, you can at least pay the minimum payment every single month. That way, you will not get a late payment that's reported. And then it'll also remind you to look at your statement. You should always be paying the full balance, of course, from the previous cycle, because you want to make sure that you don't have any interest, and because interest can, it could be crazy. But worst case scenario, if you just at least did the minimum, you won't have to ever worry about getting a late payment reported and then potentially dropping your score and also causing your credit line to dramatically decrease and be affected by this. Okay. On your application, when you're applying for this credit card, American Express Platinum, Gold, Blue, whether it be on personal or business, whether it be any of their travel cards, do not inflate the revenue on your application unless you are able to actually provide them with documentation that proves you make the same amount of money that you put on the application. Anytime you state that you make over $72,000 on the American Express application, it is possible a manual review can be triggered. Note, you can include your income and your roommate's income, or your income and your spouse's income. They can be combined if you're in the same household. So if you do that, you can prove, like you can give a bank statement for you, a bank statement for them. You can prove with documentation that you do make what is stated on there. Now, I'm not talking about that. I'm talking about if you're working a job right now and you're making $40,000 and then you state on your application that you're currently making, $120,000 because you want to get a higher limit, that you are better off just putting what you actually make and then spending the card as need be and getting your credit line increases. You will be much better off by doing that than lying on the application, because if you state that and they ask for what you're making, you need to cooperate with them. You need to provide it. Worst case scenario, they will look at your actual stated income from what you actually make and they will probably reduce your limit. That is going to be the worst case scenario. But you also don't want to have your profile associated with something like that, where they had to decrease your limit because you did not state the correct revenue. That does not look very good. Okay. So that is something that we definitely want to avoid. Just don't inflate the numbers. I would say that is just, that's just one thing to avoid. Now, for credit limit increases, you probably heard this from individuals on YouTube, or you heard it on Reddit forums, but it's pretty widespread that if you have a credit limit increase over $35,000, this will trigger a manual review. And usually you request a credit line increase, you get a manual review from American Express. They ask you to send some documentation. So if you have a $12,000 limit on one Amex and you have $14,000 on another, you should only ask for $9,000 more. Another alternative to this, would just be to get a charge card. The charge card is a better option simply because they have no limit on a charge card. They have a pay over time. Like my pay over time is like $80,000. I also have the spending power of like $50,000, $60,000. It keeps going up because I keep using it more, but the spending power is very, very high on this card. And it's a charge card, but just as well, if I'm able to spend up to $50,000, $60,000 for all intents and purposes, that is a $50,000, $60,000 credit line. So even if my credit line stays somewhere in the range of $35,000, you should be okay. I have heard other things too, where this limit increase can be triggered with $25,000. I'm not sure if that's on the personal side and $35,000 is on the business side, or it could be a combination of both. But just in case, maybe even keep it up to $25,000 for credit line, and maybe not going over that. Just maybe, just to be safe. And then get charge cards for the rest of the American Express products, and you'll have that flexible spending limit. That way, you don't have to worry about getting in trouble with that. Now, if you do have the funds to actually match, because in these situations, a lot of people talk about the manual review, but if you have the income to back it up, just send the documentation. It's not a big deal. I mean, if you can do that, then there's no problem. Like for me, I can definitely send documentation to prove that I make the money that they want to see. So it's no problem. I can definitely do that. I don't mind providing that if it gets triggered. If I didn't, that would be something that I would want to avoid at all costs. Okay. Now, the next thing is I would never outright cancel any of the American Express cards. Ask for retention offers. So here's the thing. If you have an American Express card and let's say you just don't think you're getting the benefits from one of your cards, maybe you got the platinum card. And for me, I think that the platinum card is overrated unless you're using all of the rewards, like the travel and all that. If you're using it, it's not overrated. But if you just got the card, the annual fee is, I think, around $700. It's a really high annual fee. If you're not using that card to its full capacity, you may want to just, you might be like, I really just want to cancel it. Before you do that, ask for retention offers. You never know what they're offering. The more you use your card, the more valuable you are to American Express, and they may give you a really, really good offer on that card. You also want to make sure that, if that was in your mind, make sure that you transfer your points over or you redeem your points before canceling your card. These are all things we definitely want to keep in mind. We don't just want to outright cancel anything unless we make sure that we have talked to retention, especially if it's a business one. Doesn't really matter, right? It won't affect your account history. It really won't change too much. Business is one thing. On the personal side, canceling can potentially even affect your history, what you're seeing on your credit line, which can also decrease your credit score. So with that said, there's a lot of things to consider before canceling your cards, even more so on the personal side, maybe not as serious on the business side, but again, you want to consider it. All right. And if you do cancel, let's say that you're just done or you just really only need one card because you want to put the spend on this one Amex card. You want to make sure that you allocate your credit line. Some people don't know this, but like in that other example, if you had a $15,000 Amex and $12,000 on another, you can actually move one of those credit lines to the other. You don't want to just cancel it and now all you have is a $12,000 or $15,000 credit line. Make sure you move that credit line over. All right. So if you do decide to cancel, move your points or redeem your points, reallocate your credit line to the other cards that you have open. That will always be the best thing that you can do. All right. And that will wrap up the 10 things that you should never do with American Express. Now, if I think of anything else, I will definitely make a follow-up to this video. I definitely want to say if you're using American Express business credit cards, you do want to be very careful about the things that you can trigger. I think that the business cards are even more sensitive than the personal cards. They have algorithms that they use that'll trigger when you do things that seem like abnormal spend. You want to be aware of this. You want to be aware of healthy habits when you're using these cards, making sure that especially when you have them in the first few months, you're putting active spend on them that looks very, very normal and you're building that relationship. Okay. We're not getting too many credit line increases unless we have you just want to make sure you actually can back up with documentation, usually bank statements or tax returns, the money that you are making. If you can do that, you're good to go. You don't have anything to worry about. So don't be afraid of the manual review. It does happen sometimes. It happens to everyone. Just know that you'll have to be able to show that documentation. Don't let it freak you out though. It's not a big deal if you can back it up. If you can't, be honest on the application. Don't do any excessive spending within the first, I would say 6 months, but at least 90 days. Don't do any excessive spend. Make sure that if you are spending, you are paying right away. If you do 1,000, pay it, then do 2,000, pay it. Let it gradually increase over time. It looks a lot less suspicious, and that type of spend does not trigger any flags. All right. Thank you guys so much for watching this video. I really do appreciate it. I may or may not have put out another video on Amex credit line increases. That should be coming soon. But again, I'll probably put the business credit card stacking video. I'll put that somewhere here for you to also take a look at. And yeah, thank you guys so much. I really appreciate you for watching this, and you have a wonderful day.